Heed Jamie Dimon's warning. That is the title for today's video. And before we begin, I would like to apologize for two quick things. One, the lighting. I have the light right here, but I just received it in the mail. It needs a special block. I'm going to buy that. I'm going to have that for tomorrow. I've been busy. I'm going to get these market-related art pieces up that I used to have that are going to provide additional background for the new studio that we're going to have for the next year. So I apologize for these small things. We're moving into the new place, but we've got notes. We've got a whole lot to talk about today, and we're going to get right into it. So, perfect segue. New studio. Let's take a look at what's gone on this year, because I think this has been a very bizarre year. But I think the market overall has been looking at the market in a very close-up way, focusing on individual data points, individual earnings releases, being better than expectations versus contrasting what that even means. What percent of the time earnings actually come in better than expectations? And newsflash, it's over 50% every single quarter. Over 50% of earnings come in better than expectations, even during the depths of the great financial crisis. This is how Wall Street works, okay? They underpromise and overdeliver. That's how it works. So we're going to talk about forward PEs and PEs overall relative to historical averages in a second, towards the end of the video. But first, let's talk about Jamie Dimon's warning. Jamie Dimon says it's not wise, essentially, to be locked in to this view that a soft landing is guaranteed given the risks out there. And let's talk about some of these risks, because many people view that we are now in an early cycle mode versus a late cycle mode. If you look at Mike Wilson, who says we're in a late cycle mode, and contrast that with Savita Subramanian from Bank of America, she says we're in a recovery mode. A recovery is typically characterized by a trough in economic activity and an easing Federal Reserve that has begun to cut interest rates after an economy has experienced its deleveraging, its rollover, its clear out of excess. The debt-fueled excess. I argue, and I agree with Mike Wilson, that these processes have maybe only just begun, and the real side of things hasn't fully been seen. And I think Jamie Dimon is also in that camp a little bit. So far this year, things really got catalyzed after SVB. We're just going to go over this year so far. After SVB. Before SVB, we experienced a typical January run. I read a very academic, very dense research paper that said high beta stocks, their best month is January. That's a thing. I don't know what it is. Is it hedge fund managers getting paid? Definitely could be something like that. Is it New Year mindset? Definitely could be something like that. We peak on February 1st. We get some earnings. We get some Federal Reserve. We pull back. And it's just another bear market rally like we had been seeing the entire time the Fed's been hiking and the market's been expecting pauses and pivots. Until SVB. Once SVB occurs and that bank goes under, yes, there's a sense of it's going to get worse from here. But there's also a sense of the Fed is done. We can just let go because the Fed has broken something and everything's going to get better. They're not going to let this get worse. They're going to have to start buying treasuries. They're going to have to start easing. They're going to have to start stimulating. So from the day SVB failed till now, you have seen tremendous outperformance by those tech stocks, by those stocks most heavily exposed to an easing Fed. A Fed that will come in and ease. That's what's happened. You've seen the NASDAQ massively outperform. However, that is not the case. The 10-year, just a week or two ago, took out the the decade or so high, the highest of this hiking cycle. And that's not the 2-year. That's the 10-year. That's the longer-term, neutral rate-based interest rate. Okay? And it's at highs. It's at local highs for this period. It's not pulling back. It's not coming up and going down. People thought that was going to happen very quick. It's chilling up here. And who knows? Maybe it goes higher. Maybe it goes higher. It might go higher because another one of Jamie Dimon's risks that he sees is oil prices rising. And if you know me, if you've been following my Twitter, if you've been watching these videos, I agree. I agree. The deficit, the supply-demand on a daily basis, deficit is bigger than at any point last year. Yet global inventories are depleted. A big reason why oil was not able to get out of its way for the last year or so. Yes, there was the SPR, but additionally, interest rates were higher. So when interest rates are higher, it's also true of stocks, but it hasn't really been so true recently. The risk-free rate of return goes up. So when you have higher interest rates, to just sit in something that is just an asset, it's not as good because you have a better rate of return to sit in something else. So what do people do? They unload inventories. They push inventory onto the market. So not only do we not have SPR as much, we have lower inventories otherwise, and we're still getting inventory drains on a daily basis. So there's there's no surplus in oil. There's no surplus of oil. There's no supply greater than demand of oil. So if there's no supply greater than demand of oil, how are we going to get oil prices peaking or falling? We're not. So what's the last possible outcome? It's oil prices rising. So then you take oil prices rising with inflation ticking up. The market has been celebrating falling inflation every single month, saying, oh, it's going to fall like a rock every single month since midway through last year. And here we are, starting to tick up again. It's proving to be more sticky. And guess what? My assumption is August inflation is not going to be so hot. September inflation is not going to be so hot. The fourth largest oil refinery in the world just exploded and was taken offline. And most importantly, because this segues us into the next thing, one more Federal Reserve hike, it's not going to do anything. It's not going to matter. Yes, maybe some slight pressure on inflation. Definitely maybe some psychological thing. Is it that important? I don't think so. What I think is more important is this. Adjusted for inflation, pandemic savings are now negative. This is information analysis out of JP Morgan, Jamie Dimon, JP Morgan. Adjusted for inflation, remember how the bulls were always talking about, and when I was a bull, at that time I was talking about as well, back in 2021, consumer savings were high, pent-up savings, pent-up demand. The consumer balance sheet, they got more savings over pre-pandemic levels. Yes, the consumer in nominal terms right now currently has more savings than they did pre-pandemic. But adjusted for inflation, pandemic savings are now negative. Adjusted for inflation, savings are lower than they were pre-pandemic. Okay? Delinquencies are up. Credit card, consumer loan, and auto loan delinquencies are at decade highs. The highest not seen since the great financial crisis. I don't think this trend is going to stop now that savings are negative in inflation-adjusted terms. I think these trends are going to continue. I think unemployment's going to continue to tick up. I think the economy is going to continue to soften. And I think what is just trends, normalizing behavior, you're going to hear the banks talk about normalizing because they don't want to say this. They don't want to say delinquencies are up. They don't want to say their business is getting worse. They don't want to say that. They're going to use the term normalizing. But when you hear the term delinquencies are normalizing, take that word and light it on fire. Normalizing means highest since great financial crisis and continuing to go up. That's what it means, okay? Finally, back to the multiples of stocks. Forward PEs are below their 10-year averages, or above their 10-year averages, below their 5-year averages. However, don't even consider the 5-year average. Why? Because once COVID hit, the average got skewed ridiculously high. So let's say the average forward PE was X. Because of COVID, the average forward PE, because estimates were blown out of the water, nobody knew what was happening, forward PEs just went to craziness. And stock prices went to craziness. This was the forward PE pre-pandemic. It went like this during the pandemic. So we are above the 10-year average by quite a bit. We're near the highs of the last 10 years, X 2020 and 2021. But both that 5-year, we'll not talk about the 5-year again, that 10-year average is actually skewed higher than it should be because of 2020 and 2021 by a lot. That is a lot. That is 20% of the whole average number, and that number is significantly higher than the rest. I don't have it right here. Look it up. Look what the 10-year average forward PE is for the S&P 500. We are above that number. That number is too high than it should be. We are either near or at the peaks ex-COVID for the last decade, for the last 10 years. But let's not forget, we don't have Donald Trump as president anymore. We don't have the guy who beat Jerome Powell over with the head with a baseball bat. That's what he said. He said he beat Jerome Powell over the head with a baseball bat to get interest rates lower. With a very low interest rate. That was Donald Trump. With the best economy we've ever had. Not Jamie Dimon warning of not being, he's saying don't be bullish about the economy. We have delinquencies at the highest since the great financial crisis. A more than 10-year high. The highest in 10 years plus. Okay? Oil prices rising. Oil prices way higher than they were during Donald Trump Goldilocks. There was a brief period in 2014 when they were higher, but gas prices were not higher. Gas prices last year, despite oil prices being lower, were higher last year than they were in 2014. Why is that? Because of crack spreads, because of refinery utilization. Read my article on PBF for more information on refineries. You can find that as a pinned post on my LinkedIn. So, today, the market's up. What do I think? I think it is craziness. I think it is ridiculousness. I think it is greed. I think it is speculation. I think it is people looking at things too close up. I think it is emotional. I don't think it's logical. We're trying to go over the logical stuff here. That's today's video, and until next time, when we have lighting, when we have the background all set up, peace out.